Good afternoon and welcome to our CECL webinar, Impact to Date and the Road Ahead. Can you believe it? On December 1st, 2020. So welcome everyone. Just some housekeeping items that we want to cover for CPE certification. This course will be good for 1 hour CPE credit. Just a couple of things you need to keep in mind: that you need to be logged into your unique link and stay logged in for the entire webinar to ensure that you receive the CPE credit. And as participants, we must answer 80% of the poll questions to receive the CPE credit. And then we will distribute the certificates within 7 days of the webinar via email. Email certificates will be delivered from certificates@simplecert.net. And any questions about the certificate process can be sent to marketing@cricpa.com. If you'll note that the slides for the webinar are in the handout section, so you can pull those up and follow along as Doug Mims goes over those. We do have a poll question that we want to get everybody to sign on to. And the poll question is, this is not a subject matter poll question, but if you would answer this for us: are you taking this course for continuing education or not? If you could answer that yes or no, we would appreciate that. We'll give you a few minutes to complete, but I think we can close that poll now, please. And I'd like to introduce our presenter today. It's Doug Mims. Many of you may know him, but Doug is a CPA, an MBA, a CIA, and he also has his CAMS designation. Doug is also one of our industry line leaders for financial institutions. He's also a financial institutions assurance and advisory partner in our Atlanta office. CRI currently ranks as the top 25 accounting firm in the US. We're top 10 in Atlanta. Doug has 30 years experience in accounting for banks. He had 10 of those years with PwC. He has experience with both privately held and publicly held traded financial institutions. And he's got extensive experience in internal audit, Sarbanes-Oxley compliance, mergers and acquisitions, anti-money laundering. He's a frequent speaker and content contributor on audit and insurance related matters. Doug is currently leading our efforts here at CRI in developing internal and external content and training related to CECL. So we're just pleased to have Doug today to start our webinar. So Doug, we'll turn it over to you.
Okay, thank you, Phyllis. Of course, Phyllis is the moderator, and Phyllis is the financial services industry line leader for the firm. Phyllis is very active in the profession, and a couple things of note about Phyllis is I guess it's been a year ago she received the Lifetime Achievement Award from the Alabama Society of CPAs, and just recently, within the last 2 weeks, she was recognized by the AICPA as one of the most powerful women in accounting for 2020. So a little kudos there for Phyllis. But thank you, Phyllis, and appreciate the introduction.
Thank you, Doug.
So we're back to CECL, and I know I kind of took a look at the attendee list, and there's some folks who have been on here before, and that's great. So some of the things that you'll see in here will be similar to what you've seen and heard before, but we also have some new participants, which is also good. But so I'll kind of go through here and talk about what we're going to cover. We do have a lot of material to cover in a short window. The reference to the handouts, I do encourage you to grab the handout and take it, because the amount of information in the handout, we won't cover everything in there, because if we did, we'd need probably a couple hours instead of just an hour. So, but it is designed that way because it's a takeaway for you to reference later. So please do grab the handout in the handout section. So the first thing we'll do is talk about what's happened with CECL to date. We'll talk about the tools that are available from a practitioner standpoint, or from a banker and credit union professional standpoint. We'll talk about the allowance for credit losses and what that means. It's now the ACL. It's no longer the ALLL. We'll talk about what's changed and what's not changed. We'll cover some of the methodology in CECL. We'll talk about past events. We'll talk about current conditions and the forward-looking aspects of CECL. We'll also cover the WARM method, the weighted average remaining maturities method of reserving for loan losses. We'll cover the interagency statement on ACLs, and we will also talk about some CECL solutions. If you kind of backtrack just a little bit, this is our fourth CECL. This is number 4 in our CECL series. The first one that we did was really a high-level overview of CECL purely from an accounting perspective, from a FASB perspective, if you will. The second one we did, we got a little bit deeper into some of the concepts that are included in the methodology, a little bit deeper dive. And then the third one, we kind of did a review of the things we'd done in the first two, but then we went into the regulatory guidance that had been issued. So the FFIEC has issued guidance on accounting for loan losses, ACLs, and so we went over that, and that was a focal point of CECL 3. So with CECL 4, we're going to try to tie it all together and kind of post-pandemic, the Q1 20 adopters, kind of what did that look like? And now for the 5,000 banks and the 5,000 credit unions that are left out in the world that need to adopt it over the next 2 or 3 years, what does that look like? So a little history lesson, a little reminder. It's been quite a journey. If you're sitting here and you're a community bank and you've been talking about CECL for a while, it really has been a while. The initial exposure draft was in 2010. The revised exposure draft, at that time, this standard or this exposure draft received more formal comments during the comment period than any exposure draft in the history of the FASB. I don't know if that's still true now, but at that time it was. So it took a couple of years just to get to a revised exposure draft. Then the actual standard was issued. So I'll reference this just once because we'll refer to it collectively as CECL, but Accounting Standards Update, ASU number 2016-13, Financial Instruments Credit Losses, was issued in June of 2016. So initial exposure draft in 10, revised in 12, more comments, went through the process, finally finalized in June of 16. Initially, the effective date for all SEC registrants was Q1 of 2020. That stayed the same. Non-SEC registrant PBEs was Q1 of 21, and all other private companies was supposed to be Q1 of 21. Well, that's not the case anymore. What really wound up happening is the largest SEC filers adopted Q1 of 20 this year, and everybody else, the other 5,000 banks and the other 5,000 credit unions, are deferred for a Q1 2023 start, and that's where we are today. So some regulatory feedback, and in September, I participated in the AICPA National Conference on Banks and Savings Institutions, which is a great conference. It was virtual this year, but still a very informative conference. Several of our professionals go on an annual basis. And there was some regulatory view provided at that time. And kind of here's the overview of the formal presentation by the OCC of how they saw CECL play out. Now, keep in mind, this is in September of this year, so we've already, the largest SEC filers has already adopted. So this is the view. They felt like it provided greater flexibility and the ability to appropriately reserve now, meaning reserve, now for the future, the prospective part. It mitigated reliance on historical data and lagging indicators, a move away from the incurred loss model. It brought together multiple disciplines within the adopting institutions. They felt like it kind of reduced silos, particularly in larger banks, but I think there are silos even in smaller institutions. It served to align accounting and financial reporting with credit risk management. So from the OCC's perspective, it actually provided the opportunity to align accounting and financial reporting with how the bank actually manages credit risk. And then it also improved transparency around the allowance, and that's the OCC's view. And I'm trying to move forward here, sorry. A few other views. At this time, I think there were discussions about further deferral. I mean, this is subsequent to the CARES Act, September. You know, we're in the pandemic at that time, didn't know how long it was going to last or that where we would be. But so the OCC's view was they continue to support an expected credit loss model. So they weren't turning back in their view. They support independent standard testing, and really what that means, quite frankly, that was a nice way of them saying they don't think that the legislative branch of government should intervene in FASB business. They support a scalable implementation for community banks. So, let's say, hey, let's be reasonable about how we do this. We've seen how it works at the big banks. It still needs to happen at the smaller institutions, but it needs to be scalable. It needs to make sense. And then they fully support regulatory capital and accounting standards as separate and distinct matters. I will point out for everybody to have context, while this is attributed to the OCC, this panel, which I also listened to the same panel today, and I'll get to that in just a second. That panel is made up of the Federal Reserve, the FDIC, and the OCC. And there might have been somebody else in there, but so it is, even though they're speaking for their individual agencies, they're really speaking with one voice. So I would say this is common, even if you're not an OCC bank. I think that's the collective view of the regulators. I will point out today they had an update to the conference. It was a one-day update, and so I was interested to see if anything had changed or if there were any further observations since that time. And I'll just offer a couple of thoughts that were conveyed today. The OCC, again, kind of giving their overview, said they observed rapid reserve builds compared to the Great Recession. So they're saying CECL resulted in rapid reserve builds as opposed to what happened in the Great Recession, which everyone collectively believes they were too slow to reserve and it was too late. While still maintaining robust capital levels, there has been some concern related to appropriate documentation of key assumptions, forecasts, and other things, particularly related to COVID. So in certain September 30, there had been no concerns or MRAs that had been issued related to the adequacy of the allowance for any institution they had inspected. So that was kind of their update to their view of CECL for the folks who have adopted. So let's talk about what that's looked like for the folks who have adopted. So the CARES Act provided the opportunity to defer the adoption of CECL to the end of the state of emergency, essentially, or January 1 of 21. So 45 banks of the 197, so there were 197 banks that were required to adopt as of Q1 20, as of January 1, 2020. 45 of those opted out. Of the 45 that opted out, there were 7 that were less than $3 billion. There were 14 of those banks in the 3 to 5 space, 29 in the 5 to 10 space, and there were 3 over 10 billion that opted not to adopt. So those 45 banks will have to adopt, as of right now, absent any further legislation or anything, extension of the CARES Act or whatever, those 45 will have to adopt. So if you do the inverse of that, what is that? About 152 banks did adopt this year. We'll take a look at what the impact was. So for the 152 adopters, and I'll preface this by saying this is a wide range. I mean, this is the largest banks all the way down to, banks that might be, 3 billion or 2 billion or whatever, smaller community banks. So it's a little bit skewed, but overall in the aggregate, this is what it looked like. those of the adopters, their allowance to loan ratio was 0.89 on December 31/19. At adoption, it moved to 1.21. At Q1, it moved to 1.47. And as of June 30, which is when I pulled this data, it was at 1.66. I will say the updated 9/30 data is not very different than the 1.66. The activity in Q3 in terms of reserve build for CECL was minimal in Q3. So that's some of the data I got today. It's been out there, but it's kind of hard to aggregate it. So very minimal impact 9/30. So if you're really thinking, hey, what did CECL look like for the largest banks or the folks that had to adopt? This is what it looked like. So the average increase at adoption was 36.4%. I'm assuming most of the folks on this call are in the 5,000 that haven't adopted, or you're associated with an institution, a bank or credit union that hasn't adopted. I'm not suggesting that you can expect 36.4% increased reserves. But for the banks that did adopt, that is actually what did occur. So from an impact of adoption perspective, the adopters' provision to average loans was 0.44% and 0.15% for Q1 and Q2, respectively. Those opting to defer, so these are the folks who didn't do it, their provision to average loans was 0.35 and 0.15%, respectively. So that even the folks that didn't adopt had an increase in provision, and presumably that was COVID driven. 2020 adopter sizes ranged from 1.3 billion to 3.1 trillion. I kind of jumped ahead of myself. That was it's all relative. So just wanted to make sure you understood. There's some true community banks on the bottom end of this, but then there's Wells Fargo and the rest of the bunch up at the top end. The 45 institutions that did not adopt or presumed to have to adopt 1/1/21, I already said that. That is in fact the case, and I'll cover a couple things on that in a minute. So there's approximately 5,100 community banks scheduled to adopt as of 1/1/23, along with all credit unions, which is approximately 5,100.
Okay, thank you, Doug. We're up to our first subject matter poll question. Remember, you need to answer this question if you want to get CPE credit. So the question is, 197 banks adopted CECL as of January 1st, 2020. Is that true or false? We'll wait a few seconds and then we'll close the poll. I like these true false questions, Doug. A lot easier. You'll have a 50% chance to get the right answer.
they're a lot easier to.
Yeah, you don't have to know the right answer to CPE credit either, so that's good. But if we'll close the poll, and then Doug, if you'll give us the answer, we would appreciate it.
So 197 banks adopted CECL as of January 1, 2020. That is false. 152 actually adopted. 45 took the out from the CARES Act and will be adopting January 1, 2021. So the answer is false.
Thank you.
Okay, tools you can use.
Doug, I don't know if the slides are moving because the poll's still up.
Okay.
On the screen.
I don't see the poll. So, Nathan, is there something I need to do to?
There you go.
Okay. All right. So, tools you can use. These are just the various tools that came out over time.
Hey, Doug, I don't think the slides have caught back up yet. So, there you go. Thank you, Nathan.
Okay. All right. Yeah. Nathan had to intervene and then give it back to me. Okay. Sorry about that, folks.
Thank you, Nathan.
So there have been a variety of tools, if you will, that have come out over time, and there was a long period of time, quite frankly, where there was no real guidance other than the standard. And then the regulators began doing some things, to help banks and credit unions be exposed to the standard, and to implement how to implement. So you got ASU 2016-18 is actually the standard. If you're looking, 109 pages 109 through 123 are actually the real meat of it, if you will, that you'd want to look at. The FFIEC held 3 webinars, which are still out there and recording and available to you. Those are good, and I will say this, that the regulators, they brought all the regulatory bodies together, including the credit union regulators as well as the state banking regulators, and they had representation from the FASB and from the SEC in these webinars. So they were trying to speak with one collective voice, which I thought was really good, because we didn't want to have big gap, little gap. We didn't want to have regulatory, wrap gap. And I think they've done a really good job of keeping that from happening. There is a FASB staff Q&A out there on the weighted average remaining maturities method for reserves that as of January 2019. I encourage you to look at that. There's also an FAQ, FFIEC FAQ, that was updated as of 4/3/19. It may have been updated again since then, but there is an FAQ out there, and it's good. The Center for Audit Quality has put out a CECL tool for audit committees in May of 19. The AICPA has put out a CECL practice aid, and the FFIEC interagency guidance, which we will cover today, on the allowance for credit losses, was issued final this year in March. So those are some good tools that you can reference if you're trying to build your knowledge level in and around CECL. So goodbye ALLL, hello ACL. So what is the allowance for credit losses? It's a valuation account that is deducted from the amortized cost basis of financial assets. It's used to present net amount expected to be collected. The changes flow through net income. And I do have the standard references. That's 326-20-30-1. When you see that, you can actually go read it with more context in the standard. In other words, nothing new. The name has changed, but the concept is the same. The allowance for credit losses is the same as the allowance for loan losses from a practical perspective. How you get there is different, but it's the same. So A is the amortized cost of the unpaid principal balance lent to the customer. B, C is the remaining amount to be collected. So you got the amortized cost that includes that's been adjusted for loan fees, origination expenses, repayments, write-offs, etc. You've got the remaining amounts actually expected to be collected, which is what you estimate, and the difference is the allowance. So, and this is something we went over early on in CECL 1, so it's pretty basic, but not any different than what we're doing today. Again, how we get to the amount that the reserve is what's different. So the more things have changed, the more they have stayed the same in some respects, which is what I just said, right? I forgot to put that on the slide. Okay, so today, asset classes have required estimation methods. Pooling is permitted but not required, and you recognize losses when probable and estimable. Okay, that's today. Under CECL, there's a single impairment mode. Pooling is required when assets have similar risk characteristics. Okay, so an example of pooling with similar risk characteristics are call codes. That's a pooling based on similar loan types. But just to give you a frame of reference, under CECL, you have to include reasonable and supportable forecasts. That's not required today. There's no threshold to recognize losses. No complex estimation models are required. You have to be sure to consider past events and current conditions, but that is part of what we do today. And CECL requires judgment. Well, today's model requires judgment. So really, the requirement to pool and the requirement for reasonable and supportable forecast, if you I won't say dumb it down, but if you break it down to simplistically, what's the primary difference if you're a small, less complex institution? That's really the two things that are different. But the truth is that most everybody's pooling now by risk characteristics. Most community banks are doing it by call code. And so, that doesn't have to change unless you think it should change. And this model requires judgment. So just keep in mind too, the only thing that CECL changes is the timing of the loss recognition, not the amount. Theoretically, you would have the same loss under CECL over the life of a loan as you would under the incurred loss method. You would just recognize it sooner. And this is kind of graphically, you can kind of see, or with this diagram, you can kind of see what the pieces are. Under current U.S. GAAP today, we've got the unadjusted historical charge-off experience. We add our good old Q factors. We factor in the loss emergence period times the loan category balance, and we get our ALLL. And if you look here under CECL, it's very, very similar, except that, it doesn't include the loss emergence period. The other thing I would say is the qualitative factors under CECL also include forecasts. So if you see current conditions versus current and forecast, but the big deal is the forecast piece, and we'll talk about that more as we move through this.
Thank you, Doug.
We're to another poll question.
Yeah, we're up to our second poll question. So here it is. Past events and current conditions will not be included in CECL. Is that true or false? We will allow a little bit more time this time, Doug, on the poll question, just to make sure everybody has a chance to open answer. A little over 50% have answered so far, so we'll wait just a couple more seconds. Keep in mind, you need to answer these questions, to get your CPE credit, whether it's right or wrong. So I think now we can close the poll. We've got about 76% that have voted, 77%. And so, Doug, will you give us the answer to that one?
Past events and current conditions are part of the model that's used today. Those attributes will also be part of CECL. So past events and current conditions will not be included in CECL is false. They're in today's method. They'll be in the CECL model as well. So the answer is false. Will not be included is false. I almost tricked myself on that one. I was about to think the answer was true, but
you did good because 90% said false. So you're doing good on your sessions. That's good.
All right. Let's see if the slide. Okay. Let's see if we can get the slide to move this time. You got past events, Phyllis?
Yes. Good.
Okay.
It worked.
All right.
Thank you, Doug.
All right. So I'm going to move through this pretty quick because I think I'm kind of lagging on time a little bit. So historical credit loss information is the past events part. All of this is what everyone is doing today. Everyone is taking over some time horizon. They're calculating. Typically, they're pooling their loans, and they are calculating their historical losses by pool, and they are applying that loss percentage to that pool in the incurred loss model. This is no different. What CECL says is that generally credit losses will provide a basis, but it won't provide an adequate basis holistically, and that you have to consider other things. So it says you shall consider adjustments for current asset-specific risk characteristics within a pool, for the contractual terms in the pool, and different economic conditions. Common adjustments to historical credit loss information might include changes in underwriting or historical losses from a different point in the credit cycle. Quite frankly, there's nothing different about this than what we're doing today. It's the same concept. So past events current conditions. Current conditions, also known as Q factors. Qualitative adjustments are permitted under CECL to capture current conditions and reasonable and supportable forecasts. They identify information relevant to assessing the collectibility of cash flows, and such available information may relate to past events, current conditions, or reasonable and supportable forecasts. So what the qualitative factors are meant to do is to take historical losses, and to the extent they don't represent for some reason what you expect, what your losses should be based on current conditions, or what you expect your losses to be based on forecasts, then you would adjust those historical losses with qualitative factors. Again, theoretically, that's what you're doing today. It's no different. Adjustments to historical data or charge-off rates bridge the gap between loans in the current portfolio as of the reporting date and loans in historical data sets. So historical losses by definition are based on historical loans, loans from the past, and the Q factors bring that information current and then look forward with it. So what CECL does that the incurred loss model doesn't do is it looks ahead. And so when you talk about looking ahead, you're talking about forecasts. So let's talk about developing forecasts a little bit. You consider relevant quantitative and qualitative information to assess collectibility. This information can include internal information, external information, or a combination of both. You're not required to search for all possible information that's not reasonably available, and you may find that internal information is sufficient. So if you go back to the OCC's reference that the adoption of CECL needs to be scalable, in other words, it needs to make sense for a community bank, I think in these instances, they're going to expect that you're going to build in forecasts and that you're going to develop those forecasts and build that into your reserve methodology. But I don't think they're going to expect it to be as complex as they would for a larger, more complex institution. You're not required to develop forecasts over the entire contractual term. You're not required to correlate or reconcile reasonable and supportable forecasts to macroeconomic data. And you should consider refining future estimates based on actual experience. So these bullet points are really trying to say, trying to keep it as simple as possible, recognizing that there is a complexity standalone by just having to look forward. So in summary, focus on the factors relevant to collectibility. You don't have to consider things that aren't relevant. Adjustments do not have to be macroeconomic in nature. Acceptable forecast-specific events, such as a factory foreclosure, even if other forward-looking information is only reasonable and supportable for a shorter period of time. So, again, if there are certain events in your marketplace that have happened or are going to happen, you should take them into account. And that's really what it's saying, and it uses an example of a factory foreclosure. So we're to another poll question. We have to get a lot of poll questions to get NASBA credit. Sorry about that.
So we are at question number 4. The CECL methodology does not require consideration of reasonable and supportable forecasts. Please select one, either true or false. So if you'll go ahead and click on one of those answers and submit your poll, that would be great.
Does not require consideration.
Does not require consideration. Did I say does require?
No, you said it right. I was just emphasizing. Okay. I was trying to help them out.
We've got about 66% voted so far. Remember, you have to answer 80% of the questions to get credit for CPE. Doesn't have to be correct. So we've got about 78% have voted, so we'll close the poll. And Doug, if you'll give us the answer.
The answer is false. The CECL methodology does require consideration of reasonable and supportable forecasts.
Great. Thank you, Doug. About 90% answered false, so that's good. Thank you.
Okay. The next section, it's getting warm in here. So I made reference earlier to a Q&A that was developed by the FASB that covered the warm method. And basically they put it out. It's the only one they put out about a specific method, because if you read the standard, it says you could use a variety of different methodologies. There's no one. In fact, you can use not just that, you don't have to use any one individually. If you think that a certain methodology would better reflect your allowance for credit losses on certain pools of loans, you can have more than one methodology. Although that seems quite complex for a less complex institution, it is allowable. But the FASB said, hey, by the way, we like the warm method. They didn't say you got to use it. The regulators in the banking regulators in those webinars that I mentioned go over the warm method in 2 of the 3. So nobody has endorsed the warm method, but I will say this, the warm method is for our clients, the warm method that aren't using probability of default tools, the warm method is the closest thing to what they've been doing that I've seen. So I think it's the easiest progression, and while it's not been endorsed by the regulators, they've done everything but endorse it. So with that, if I'm someone who didn't have to adopt yet, and I'm not a January 1, 21 adopter coming up, I think that I would look hard at the warm method. So we'll kind of go over the aspects of that. So the remaining life method utilizes average annual charge-off rates and remaining life to estimate the allowance for credit losses. For amortizing assets, remaining contractual life is adjusted by the expected scheduled payments and prepayments. So you do have to estimate prepayments. Average annual charge-off rate is applied to the amortization adjusted remaining life to determine the unadjusted lifetime historic charge-off rate. Sounds a whole lot, other than the estimating prepayments, sounds a whole lot like what's being done today. So A is the average annual charge-off rate. B is the amortization adjusted remaining life. It results in a lifetime historical charge-off rate. That's the warm method. What factors should an entity consider when determining whether to use the warm method? Some of the questions you should ask yourself: how complex is the pool of assets? What's the contractual term of the pool? What extent of the loss history is available? Are the losses sporadic with no predictive patterns? How many loans are in the pool? Does the composition of the pool vary significantly from historical pools of financial assets? I think on most of these, for a traditional, smaller, less complex institution, you're going to come to the conclusion that the warm method is a viable option. Not that you would absolutely do it, but that it could be a viable option. So let's look at an example. So if you look in the table, you got A, B, C columns there, and you got the amortized cost, you got the average balance, actual annual net charge-offs. You come to the annual charge-off rate, and then in this instance, based on these pools, based on this, you come to an average annual charge-off rate of 0.36%, and this is just for one pool. Again, pools, you know, if I'm a community bank, when I think pools, I think call codes. You come over and you take the you estimate the pay downs. So you got to estimate repayments. So that is an estimate. That is something you have to come up with. The projected amortized cost going forward. You apply your 0.36% that you calculated on the other page, and you come up with a reserve of 126. And so that is a 0.9%, I think, reserve. Then you make qualitative adjustments, and we don't go into that here. But anyway, you wind up with a 1.15% on the 13,980 for a reserve of 161. But this methodology is very similar to what's being done now. It is a little bit more complex, but it's very similar. But it doesn't. So the first piece, the 0.9%, the 126, that's your historical piece. You still have to take into account current conditions, just as you do today, and you still have to put into place reasonable and supportable forecasts. But this is a way to look at historical losses.
Okay.
And we're to another poll question.
Thank you, Doug. We're on question number 5. We've got a total of 7. So we're on number 5. So if you'll launch the poll. The warm method is not required for CECL. True or false? If you'd go ahead and answer that and submit your answer. A little slow response on this one. We've got about 37, now 49% that's responded. So we'll wait a few more seconds. Okay, we got about 78% that's voted. So we'll go ahead and close the poll, Doug, and you can give us the answer.
The warm method is not required by CECL. That is true. It is not required by CECL. A method is required, but the warm method is not required.
That's good. We got 84% said true, so that's good.
Okay, so we're past the FASB part. Now we're going to talk about the interagency statement on ACLs, and we're going to have to hit the high points because it's pretty voluminous. We did a whole webinar on this, but try to hit the high points, give you an idea of what. So you've got the FASB that says out here, hey, you got to adopt CECL, and then the regulators have come in and they've said, for the most part, hey, we agree with everything the FASB says. You should adopt it. We don't have a lot of deviations from a regulatory perspective, but here are the processes and controls, and really the written policies and procedures supported by actual activity that we're expecting to see when we come into your institution. But as I go through these, always remember scalable. Scalable is important. So this is what gets scoped out of CECL with clarity from a regulatory perspective, but this is consistent with the FASB. Financial assets measured at fair value through net income, including those assets for which the fair value option has been elected. So financial assets that are measured at fair value aren't included in CECL. AFS debt securities are not included in CECL. Loans held for sale, they're carried at fair value, not included in CECL. Loans and receivables between entities under common control, not applicable to CECL. Receivables arising from operating leases, CECL doesn't apply. That's not the whole list. That's a subset of the list. But those are the things that I thought would be most common to this audience. So those things are scoped out of CECL. Just some overview information. Methods used to estimate CECLs generally should be applied consistently over time. Changes to ACLs via periodic evaluations are recorded through increases or decreases to the provision for credit losses. So your old provision for loan losses is now PCLs, provisions for credit losses. The periodic evaluations, I think that's pretty well for a smaller, less complex entity, or really any entity, but it is quarterly. The expectation would be quarterly. You would do an assessment and then record your PCL accordingly. Specifically identified uncollectible amounts should be promptly written off against ACL. So it's saying, hey, If something's not collectible, you charge it off. Whatever CECL says is CECL, but we still expect you to charge off losses. Estimation of ACLs involves a high degree of judgment and is inherently imprecise. Now, this is coming out of the regulatory guidance, the FFIEC guidance. It may result in a range of estimates, with the best estimate being supported and recorded. From a regulatory perspective, this is a bit of an overview of collective evaluation. Examples could include, but would not be limited to, internal or external credit scores or credit ratings. In other words, how you group your loans for the calculating loan losses. These are some ways that you could do it. I keep mentioning call code, or I've mentioned a couple times. Here's some other ways you could do it. You could do it based on internal or external credit scores or credit ratings, risk ratings or classifications, financial asset type, collateral type, size, effective interest rate, term, geography, industry, or vintage when the loan was originated. So it says, hey, you can group these from a common risk perspective. However, it makes the most sense to get to the best answer. There's no one way to do it. I just want to point out there are other risk characteristics related to HTM debt securities that are included in the policy statement. So while we said AFS securities are excluded from CECL, HTM securities are in scope for CECL. Topic 326 does not prescribe a process for segmentation. Segmentation should be evaluated on an ongoing basis to ensure pooled assets continue to share similar risk characteristics. So it gave you a bunch of examples, but it says, hey, you need to continually reevaluate, and if you determine that there's another way to do it to get to a better answer, then that's what you need to do. Financial assets that do not share similar risk characteristics with other assets can be evaluated individually. So if you have a loan that's different than every other loan in your portfolio that just doesn't belong in one of your buckets, you can pull it out and evaluate it individually. But that's not an impaired loan. That's not what it's saying. It's saying if there's a loan that its characteristics just don't stack up, then you could pull it out and evaluate it individually. The impaired loan concept goes away with the adoption of CECL. The impaired loan concept that we use today. So from an estimation method standpoint, again, I've talked about WARM, but I also mentioned that there's a variety of ways you could do it. Here's some of the ones that are mentioned. Topic 326 does not require the use of a specific loss estimate method. Management is not precluded from selecting a different method if it results in a better estimate. The same loss estimation method does not have to be applied to all financial assets. I mentioned that earlier. You can have multiple models. Acceptable methods include probability of default, roll rate method, discounted cash flow method, a method that uses aging schedules, or other reasonable methods. So the standard says there's a variety of methods you can use. The regulators come back in their guidance and reaffirm that. You can use a variety of methods. We're not telling you how to do it. Methods selected should be appropriate for the financial assets being evaluated and be consistent with the institution size and complexity. Topic 326, and this relates to contractual term. So it requires an institution to measure estimated losses over the contractual term of the financial asset. So life of loan, you've heard that part, right? Life of loan, considering expected prepayments. So again, you have to estimate prepayments. Renewals, extensions, and modifications are generally excluded from the contractual term. So expected renewals or extensions or modifications that aren't part of the originally executed loan agreement, you wouldn't estimate those on day one, because you don't know if a loan's going to renew necessarily. You don't know if it's going to extend. You don't know if it's going to be modified. So you're not required to estimate that part, but you are required to consider expected prepayments. The exception would be if there's a reasonable expectation of executing a TDR, or the renewal and extension options are part of the contract and not unconditionally cancelable by the institution. So a couple of caveats there. One is if you think you're about to have a TDR, or if such renewal or extension is actually in the contract, or if management can unconditionally cancel it. So those are a couple of caveats on contractual term. Forecast from a regulatory perspective. They may extend over the entire contract term or a period shorter than the contractual term. Forecasts may vary by portfolio segment or individual forecast input. You're not required to search all available information or incur undue cost and effort to collect data. Multiple economic scenarios can be considered but are not required. This is a subset that I pulled out of the document. There's a lot more around this. There's a continued emphasis on we're not trying to make this any more complex than it has to be. And so I think you have to consider forecasts. You have to include them. You have to segment your portfolio and apply them accordingly. But they're trying to say, hey, this is scalable, and for a smaller, less complex institution, we need to try to keep it simple. Overview of Q factors. I'll say this about Q factors. So I'll go through the top four, and then there's 8 or 9 now. I always forget exactly how many there are, but there's 8 or 9 Q factors, and they're very similar. They're not exactly the same, but they're very similar to what you've seen before. So I'll just go through the top 4 bullets, and then I'll leave the other ones with you. But historical credit losses generally don't by themselves form a sufficient basis to determine the appropriate level of ACLs. You should consider qualitative adjustments. You may increase or decrease the estimate of loss. So it could go up or it could go down. Adjustments should not be made if information is already considered in loss estimation. And it says you should consider the following items. And I kind of reduce these. You need to look at them in the standard. They are different, but they're very similar. But I would expect that you would want to modify your methodology to incorporate what's in the new standard. But if you think about the 8 or 9 that you're using now, they are very similar to the Q factors listed here. There are
Doug,
additional.
Just to make sure you're good on time, we have about 7 minutes left, and we still have to do 2 poll questions.
I got you. Okay. Additional I'll say there are additional Q factors for HTM securities, so just know that. They're listed here. There's more context in the document. It does address collateral-dependent loans. A financial asset for which repayment is expected to be provided substantially through the operation or sale of the collateral is a collateral-dependent loan, and it in this guidance says you got to value it at fair value less cost to sell. So collateral dependent that concept does still exist from the FFIEC's perspective. TDRs still exist from the FFIEC perspective. So that should be considered in the CECL methodology. TDRs still exist. Accrued interest receivable. There's 3 independent accounting elections that are permitted at adoption. So when you adopt, you gotta say how you're going to handle accrued interest. And there's 3 options here. I encourage you to take a look at those. Off-balance sheet credit exposures are part of CECL. This is a big one. A lot of people don't realize, but off-balance sheet credit exposures do have to be incorporated into your CECL methodology, and to the extent there are estimated losses, then you would accrue for those losses even though the related credit exposure is off balance sheet. As I mentioned, AFS debt securities are in the scope of this document, and I'll just say this. For an AFS debt security, it requires credit losses to be calculated individually rather than collectively, and you have to use the discounted cash flow method. So that's coming right out of the document. All right, we got a poll question.
Okay. This is our 6th question. Off-balance sheet credit risk should be considered under CECL. True or false? We could answer that quickly.
Should be considered under CECL.
Got about 30% that's answered. So if you could answer that quickly. We've got one more poll question. Doug has some really good material he needs to cover in the next 5 minutes. So we'll wait just a second. Remember to answer the question to get your CPE credit. So we've got about 76% voted. So if we can close the poll, and Doug, you can give us the answer so we won't burn into any more of your time.
Off-balance sheet credit risk should be considered under CECL. That is true. That is true. Okay, so I'm going to go. I already intended to go through this quickly. The documentation standards, I'll hit on some of the things. So it's pretty expansive. What is it appears to be expected from a documentation standpoint. Policies and procedures for the systems, processes, and controls necessary to maintain appropriate ACLs should address these things. And it talks about, so basically, who's going to do it, how they're going to do it, and when they're going to do it is supposed to be captured in your processes and controls, in your written policies and procedures, and what you actually do. So expect that investment of time when you go to adopt CECL. I'm going to skip through some of these. There is an expectation that management or a committee of management will have a rigorous process around analyzing and validating ACLs, and that would also be captured elsewhere. There's also an expectation that the model would be validated by a third party. It also specifically says that third party cannot be your financial statement auditor, and that when you get your financial statements audited, what they're saying is a financial statement audit is not a validation of your ACL, and you need one done, and they can't do it. Somebody else has got to do it because they've got to opine on it. So just know that's out there, and that there is a rigor that is expected around the ACL. So it's a documentation and document the rigor and third party validation of the tool. It also specifically goes into what is expected of the board, and I would expect these things that you would want to incorporate these into your written policies or procedures so that you can ensure your board is in line with FFIEC guidance. It also goes into pretty good detail about what is expected from management, although these are things that you would expect to be expected from management. Pretty voluminous stuff. And then it goes into, an overview of what the examiners are going to look at. What has been said in all of these venues is that the regulators are going to show up trained, prepared, and ready to look at CECL from the same lens as the FASB, and that everybody's going to be on the same sheet, if you will. So you should expect that when this time comes, your regulators will be looking not to come see if you're at 1 1/4, but to make sure you've appropriately implemented CECL. And we have another poll question.
Okay, our last one, number 7. Held to maturity debt securities are included within the scope of CECL. Are included within the scope of CECL. So is that true or false? If you could quickly answer that and submit your poll answer. We got about 50% that's answered the question. So we'll wait a few more seconds and then we'll need to close the poll. Okay, we're at about 75%. So we'll close the poll, and Doug, if you can give us the answer, then you can move on to the completion of your slides.
HTM securities are included within the scope of CECL. That is true. Okay, so CECL solutions. Just to go over a few quick things, and then I'll talk about the warm method. But if you haven't done much so far, you need to get going. You're going to need to run parallel for a year before you actually adopt in Q1 23. So that means that you would run parallel in 2022. So the heavy lifting, the data, the ownership, the beginning of the structuring the policies, deciding who your partners are, all those things that need to happen, those things need to happen in 21. And I personally don't think, or professionally I don't think, that there's going to be another reprieve. I think that all the reprieves are done and that we're moving on to needing to implement, even for the 10,000 financial institutions that are left out there. And so what I would strongly encourage you to do is to reach out to your partners and get moving. I don't think that the legislative branch is going to intervene. Pretty sure the judicial branch is not going to. And I don't think the executive branch is going to either. So I would encourage you to get moving. From our perspective, one thing that we've partnered with Bank Trends. We do have a software solution. I would categorize it as, I've seen a lot of models. I would call it the least expensive, most user-friendly model that I've seen. We'd love to give you a demo of it and help you implement it. If you can see on our dashboard, just email CECL@cricpa.com or go into our CECL dashboard webpage and fill out that information. We can do a couple things. We can actually do a demo for you, and we can actually pull your bank's data into there through your call report information and run a dummy CECL model and let you look and see kind of what it looks like under the warm method. Now, it won't be fully tailored and all those things, but it'll give you a look at, give you a view of what things look at. So whether it's us, whether it's Bank Trends, or whether it's somebody else, I just encourage you to get moving, because I really believe that we're at the point now where 23 is coming, and if time flies, it's going to be here before you know it, and 21 is the time to get moving. So I encourage you to do so. But otherwise, hopefully, there's a lot of information in the slides. Please take it with you. I hope you benefit from taking it with you, and I hope this was worth your time today. Thank you.
Thank you, Doug. And the information was excellent, so thank you. And I'm glad that everybody has the slides they can refer back to. So we did have a couple questions, but Doug will respond to those privately, individually. And just again, the presenter was Doug. And if you'll text CRI to 66866, you can receive our CRI news and alerts. So thank you again for joining us, and we look forward to our next, I hope, CECL number 5, Doug.
CECL 5. Thank you, Phyllis.
Thank you. Y'all have a great rest of the day.